Welcome to the CU 2.0 podcast.
Hi, and welcome to the CU 2.0 podcast with big new ideas about credit unions and conversations about innovative technology with credit union and fintech leaders. This podcast is brought to you by Quillo, the real-time loan syndication network for credit unions, and by your host, longtime credit union and financial technology journalist Robert McGarvey. And now, the CU 2.0 podcast with Robert McGarvey.
About 45 credit unions are customers of JUDI.AI, and they're drawn by the company's simple promise: eliminate friction in business lending. There's money to be made serving small businesses, and JUDI.AI has the formula, says Gord, Baizley, the company's CEO. The key is automating a lot of the processes, and that's what his company does. Here's why the company exists. Quote, small businesses are the backbone of our economy, but 40 to 50% of small businesses rank access to capital as their chief challenge. At JUDI, we're transforming small business dreams into vibrant communities by increasing access to capital. Close quote. That's a big promise. But, says Baizley, the company has had very, very little churn among credit unions who sign up. That's because they believe they're getting value. And also, in fact, they're finding ways to serve their community's small businesses. Just about every credit union, certainly all bigger than $500 million in assets, dreams about making small business lending a bigger slice of their portfolio. Credit unions are finding that they can do it. And some of those credit unions are as small as maybe $25 million in assets. Now, Baizley insists that dream can be reality. On the show, he tells how. We're going to talk about small business lending credit unions. And historically, as I'm sure you know, small business lending has been something credit unions have wanted to do, but they haven't done it for many reasons, one of which is that it's not usually profitable for them because the amounts in their lending are too small to justify the labor that goes into vetting the loan application, to simplify matters. I mean, and that's true with big banks too. If I walk into Chase and say, hey, I'd like you to give my small business $50,000 loan, my banker there would say, we'll give you a personal loan, but not your business.
Yeah. And I mean, you're right. It's not just credit unions, it's the broader market. And if you look at the, sentiment data out of any survey of small businesses, they'll say they're underserved from a banking perspective and a credit perspective in particular. It's a hard segment to serve. And so what's happened is, fintech lenders have stepped in to fill that void. The problem is they're not deposit taking institutions, so their cost of capital is pretty high. And so they have to pass that along. And next thing you know, your APRs are 30, 40%.
Yeah, I talked with a guy a couple of years ago who does small business lending, and he told me traditional financial institutions we're kind of dead at the starting block because they ask for the wrong data.
Right.
What's your Dun and Bradstreet rating? My what? And furthermore, yes, the Dun and Bradstreet doesn't know who this company is. Two, what's your FICO score? Well, some of them are having money problems, and their FICO score is really taking a tumble. So he said, all I look at is cash flow.
Right. Exactly.
And I assume his interest rate, he wasn't specific, but it was significantly over 20%.
Yeah, and that's the fintech lenders sort of figured this out a while back, and we were born out of a fintech lender ourselves, and then developed a platform and spun out a separate business for that business. But exactly what we learned along the way was that cash flow was really the best predictor of what's going on, and actually most recent cash flow is really important. So, we look at 12 months of cash flow data.
I think that's all this guy wanted was 12 months. If you had 24, he might look at it. But his main concern was, if I lend you this money, can you make the monthly payments? And the cash flow told him yes or no.
Well, and there are some fintech lenders that will lend on the back of only 3 months of cash flow data.
Whoa.
And we've even seen it in our data that, months 1 to 3 are much more predictive than months 9 to 12 from a finance.
Well, wait a minute though. If I open the right kind of store and I give you cash flow data for October, November, December, I might have zero cash flow in January because I'm selling Christmas gifts. It's so.
Yeah, and I'm speaking in generalities across the small business population. Obviously, there's seasonality in some businesses, but for the most part, recent data is more predictive than old data.
Oh, sure. That's
and it's pretty acute actually across the general population of small businesses.
I mean, that's essentially why I really don't like FICO scores as a measure of much of anything except a pretty good picture of my past behavior as a credit card user. But I don't think it tells you a thing about my future behavior.
Yeah, I mean, I think a certain baseline of a FICO score will tell you what kind of a person you're dealing with, and are they likely to, completely screw up or even worse, defraud you. So you get a sort of a baseline character perspective out of that, I guess. And then from there, though, you really want to know how their business is doing in real time.
Now, how many credit union customers do you have? And how many U.S.-based credit unions do you have?
Yeah, we're working with, I think we're creeping up towards 45 customers.
That's outstanding. How long has it taken you to get 45?
Yeah, we launched. So our first customer was Van City Credit Union, so the largest credit union in Canada. We launched with them in May of 2017. So that was when the first application went through our first credit union customer. And so that's 8 years ago now that we've been doing this and adding them steadily. We sort of got into the U.S. market a couple of years ago. That's been going well. We're, I think, up to 18 customers in the U.S. and more coming on. Obviously, lots of potential there. But we really, to your point, the credit unions in both Canada and the U.S., and they're very similar, have historically not done a lot of small business lending for all of the usual reasons. It's expensive and unprofitable, and so they've migrated. They've always focused on CRE to the extent they've done commercial lending. But we're really noticing a pattern now where they want to get into this. They know they should serve their members in this segment, huge important segment of the economy, and so they're starting to run at it, which has been fun for us.
What's the size range approximately of your U.S. credit unions?
Yeah, so we work with through a couple of CUSOs. We work with some very small credit unions as low as 25 million in assets, and then like I say, our largest client is 30 billion in assets, and we have a couple of those in Canada and pretty much everywhere in between. We do sort of notice that sort of 500 million in assets and up is where, if you're not going through a CUSO, where it kind of works, where they can actually absorb the cost and execute on a program that makes sense. So that's a kind of a threshold that we focus on. But if smaller ones come to us, we certainly will work with them, and we'll sometimes suggest that we pull in a CUSO to work with them and help them.
Now, remind me, my memory tells me that the U.S. has approximately 6,000 credit unions. Canada has approximately 6. I mean, I exaggerate, but
yeah,
Canada has really big credit unions, right?
Yeah, we're about 250 credit unions in Canada, and so 10% of the population. So if you were to sort of do a linear extrapolation, we should have there should be 2,500 in the U.S. to be equivalent, and there's at least double that or something like double that. So yeah, you're right. We're less fragmented and generally have larger credit unions here and fewer targets for us, but so it's a bit of a different dynamic.
Now, how does the CUSO come into the picture when you're serving a credit union through a CUSO?
Yeah, so some of the credit unions, because as you say, they haven't historically done a lot of commercial lending and certainly smaller C&I lending. Some of them maybe don't have the expertise to do the underwriting or the servicing or the reviews, and so they can outsource some or all of that process to a CUSO. And so where we can partner with a CUSO and bring both technology and the expertise and services to the table, it enables someone to get up and running very quickly without building out a whole department.
So tell me, what do you bring to the table and what does the credit union have to bring to the table, either on its own or through a CUSO?
Yeah, so we bring the technology and a little bit of advice around how to configure the technology for a program based on whatever the risk and business objectives are of the credit union, and we help them through that journey. But what we don't do is we don't do underwriting, we don't write credit policies, we don't do annual reviews, but we can provide the technology to enable all of that. So they either need people internally that are capable of that and that have the capacity. That's another thing. Sometimes it's capability, sometimes it's capacity. And if they don't have it internally, then they need a CUSO, and there are several around that provide those services.
So your technology automates the lending process. And,
yeah. So it
and,
does a few.
So in the pandemic era, and there was a lot of government money to lend in the U.S. Government-backed loans. The big banks jumped on that, like Wells Fargo did a lot of those loans. When I investigated, everything was automated. I don't know what the dollar amount was their maximum, but say it was $100,000. Anything under that was going to be automated. No human being would touch the application. Credit unions struggled with that. They didn't have the technology, I don't think.
Yeah, and it's interesting. Like, and Canada had a similar program too, so the dynamics were very similar. And you needed to automate it. There was so much volume coming, but it was really workflow, not underwriting automation. Because there wasn't really underwriting. Like they were
right. There was essentially no. But again, it's how much labor can you afford to put into this $20,000 loan?
Yeah,
very little. Basically.
Yeah, no, we've had people say to us, like, once we've touched the file twice, we've lost money.
Yeah.
So
absolutely. They'd much rather do a car loan for $30,000.
Yeah.
So
the flip side is that although they're small amounts, there tends to be pretty good margin in the segment for a number of reasons. And so if you can figure out how to control the cost of delivery and do it at scale, it can actually, like some of our clients, this is their most profitable segment. So once you get to that point, it's very worthwhile.
Now, I'm assuming you don't provide marketing advice to the credit union. In other words, here's how you go after small business loans, A, B, C, and D.
Yeah, we actually do a few things on that front. The big thing that we've noticed, I always say, if you build it, they won't come. Like, you can't just stand up a platform and expect that you're going to get applications all of a sudden. So you do have to activate it. And one of the most successful ways to activate it is to actually do pre-qualifications of your members. So most credit unions are sitting on a few thousand business members, and they're sitting on all their account data, that cash flow data that is very predictive, and we can go through that and give them a picture of who they could make offers to. And the conversion rates and the uptake from small businesses has been incredible on those types of exercises, I think, for two reasons. One, there's a high degree of trust between the business members and the credit union. And two, business members, unlike consumers, aren't used to getting these kinds of offers. And so we had one client do one of these Libro credit union in Ontario and Canada, and they had a 30% conversion rate on offers made out of one campaign, just to give you a feel for how successful that was. But again, you do have to be proactive. Pre-qual is one way to do it. You can do digital email campaigns to your members, and of course, you can get out and do more traditional digital marketing beyond your membership base. What we've seen with the credit unions is they have so much low-hanging fruit in their business member base that they haven't had to go outside yet. They can focus on that. The other area that's also interesting is, and we've got a partner, Fingoal out of Colorado, that can do some analysis on this. But they can comb through a credit union's consumer accounts and predict which ones are, in all likelihood, running a business out of those accounts. And it's usually somewhere around 10% of your consumer members are running a business out of the account. So there's an opportunity to sort of migrate those over to business services.
That's interesting. Credit unions in the U.S. is, for some years now, have technology that lets them, and it happened to me with my credit union. I didn't have a credit card. They sent me an email or a letter saying, hey, we really want to give you this credit card, like a $20,000 limit. There's no fee. Do you want it? I said, yeah, I guess so. but they're accustomed to doing that. So this is just doing that same thing with small business members.
It is, and it's easy on the consumer side because if you have a bureau score, you're comfortable doing it on the back of that typically. But with a small business, that doesn't quite cut it per your previous points that you were making around that. So you have to look into the cash flow and be able to make sense of the cash flow in the operating account to decide whether that's an offer you can make.
I don't think my credit union even had a bureau score when they offered me that. It's I
Okay.
think they just looked at my accounts, the balance in them, etc., and said,
You might have done it
"My
that way.
heavens, he's paying $4,000 a month to American Express. Why don't we get a piece of this?"
Yeah, there could be some of that. I know a lot of them, for compliance reasons, at least do soft pulls on their consumer members. So a lot of them will have that on file, and
It could be a soft pull that I never would have seen. That's
yeah.
true. That's And how long does it take a credit union? Credit union calls you up when they hear this podcast and they say, "We want to get started on this." Now, that won't happen. They're probably going to ask you to convince
Yeah.
them to get started on it, but we'll just imagine that. It's how long does the process take?
Yeah, so we usually guide people to sort of allow for 8 to 12 weeks to get live. We've done them in as little as 4 weeks. They've also gone longer depending on some of the choices and dynamics in the account. But if we keep it simple and we really want to just get up with a basic implementation, it can be pretty quick. And in fact, if someone came to us and said we need to be live in a week, we could, in theory, get everybody aligned very quickly and be live that quick. So it is. It doesn't have to be a massive project. I think people think about core conversions or massive LOS implementations and they get scared off, but this problem can be actually solved quite quickly.
Do you need core system access?
You don't need it out of the gate. No. So the way we access the cash flow data is through the account aggregators in the market. So there's a bunch of them out there that, Plaid, et cetera. We use JUDI as our primary access point. And the reason we do that is, you don't need to integrate out of the gate, which expedites the process. But B, you can also access accounts at other institutions, and about 20% of the applications we receive have accounts, multiple accounts at multiple institutions.
And increasingly, more and more of us are familiar with Plaid, at least.
Yeah.
So.
Yeah, it's a journey, and I always say it's open banking in quotations. We're not there yet, but there are an increasing number of open banking like API connections into these institutions that are one day this technology will be ubiquitous and hopefully on a standard protocol.
And what's your fee structure?
Yeah, so we charge a subscription fee for the platform that varies by size of credit union, and then we charge a fee per completed loan application. So anything that we score, basically, we charge for, and in that fee, we would absorb the cost of the bureau scores and the data connections, and so it's fully loaded. The DocuSign envelope for the loan agreements.
What's a range for the monthly fee?
Yeah, the range is as low as $4,000 a month and as high as $30,000 a month for the massive credit unions, and everywhere in between. And then the application fee is $140 for the completed.
And what's staffing specifically does the credit union need on its end to make this work?
Yeah, we recommend like 3 primary stakeholders in a successful implementation, and the first one is some sort of an executive sponsor that's really going to make sure that there's strategic prioritization at the top of the organization, and if you have that's a key marker of success. The second one would be a forward-thinking subject matter expert around lending and commercial lending that maybe wants to make a change. So somebody that's comfortable with technology and changing process, and that person would be the driver. And then a project manager just to get it going, and they don't have to stay with it, much beyond the implementation, but having somebody just coordinate with, marketing and legal and credit risk, et cetera, to make sure that it gets off the ground. And it's not a ton of work with all of those stakeholders, but they do need to be informed at least.
Have you had customers who are doing this and then decide to quit? And if so, why?
Yeah, good question. We've had, to the extent we've had churn, we had a couple that used it for the SEBA program in Canada, um, which was like the PP program and the PPP program in the US, and then they didn't continue on. They tended to be the smaller credit unions that didn't have the resources to do it. So that's really the biggest blocker that we've seen is if you just don't have the strategic prioritization and the resources to move forward. And so that's where we've sort of noticed there's a line there at around 500 million in assets where below that you may need the help of a CUSO to push forward.
I've often asked credit union CEOs, why don't you have blah, blah, blah? And the answer in many cases is that I'd love to, but I don't have the staff.
Yeah.
And
Yeah,
these are smaller credit unions. These are not credit unions, certainly not ones over $1 billion in assets. Although I'll tell you, in the last couple of months, twice now, CEOs of billion-dollar credit unions have referred to themselves as running a small credit union. Twice, two different guys. So billion is now small. Okay.
The landscape's changing for sure, and those resources are critical. And if you don't have them, it won't move forward. And one of the challenges that we see quite frequently is, like you say, the legacy, sort of the heritage of credit unions is on the consumer side typically. So the commercial side of the house tends to have it struggle a little more to get the resources for these kinds of projects to grow that side. So bit of a chicken and egg problem.
That said, many credit unions recognize that basically they're forcing their member out the door. If I start getting my business loans from Wells Fargo or a fintech, what makes you think I'm going to stay around as a credit union member for very long? And what credit unions don't like to analyze a heck of a lot is share of wallet. And a generation ago, they often had 100% share of wallet from many of their members. That's uncommon today. My credit union has maybe 15% of my wallet, maybe. It's right. And I'm perfectly happy with it.
Well, and a couple of things to that point. One is, if you deconstruct the data, about 25% of U.S. households have a small business attached to them. So it's important to be able to serve those small businesses because a big chunk of your population is going to need that service. Secondly, and this has come to light with some of our more successful clients like Van City that's now been doing this for 8 years and really leaned into it. They're now they've had months where they've done 500 applications through our platform. But they treat it as a very strategic segment. They view it because of that sort of high incidence rate in the population, but also the sort of emotional component to a small business. Like if you fund someone's small business dream, chances are they're sticking with you and they're probably bringing everything else with them. So there's a really strategic component to the relationship out of that segment.
Right. I mean, if you do a small business loan, almost certainly the business will ask for a small business credit card too, eventually, if you have that to offer. Will your system accommodate gig workers, like a full-time Uber driver, that sort of thing?
Where our system works is if the business has a business operating account, if it's a side business run out of a consumer account, we sort of think of that as a consumer loan. So it really needs to have a business operating account. So if that gig worker sets themselves up as a business, we could do it. But if it's sort of a side thing, then you'd probably treat it as a consumer loan.
Does Canada have a lot of gig workers?
We do, yeah. And I can attest to it personally with my DoorDash bill.
Yeah, the U.S. has an increasing number of gig workers, and I know a lot of institutions are kicking around conversationally, how can we better serve these micro businesses, let's call it, not even a small business, but a micro business.
And if you look at the data in the small business world, our platform will underwrite and our model extends up to 250,000. But if you look at the data, 90% of applications are still under 100,000. Like that is just where the market need is. It is really a lot of really small businesses, typically, 5 people or less. And they don't need huge sums of money, which makes it hard.
But typically, what kind of default rate do you see on the loans?
Yeah, so it varies obviously, by credit union because there's differing populations and different credit policies. So we measure the risk, but we don't tell credit unions how much to take. So they're all doing slightly different things, but in general, they play in a similar zone. And what we've seen over the course of time is an average predicted default rate out of our model based on the policy chosen by the credit union of around 2%. So far, the default rates have been less than that. So the actual has been less than predicted for a variety of reasons. But we do say that, believe the model, believe the predictions, build your pricing and your business model around the predictions, and you'll be safe in the long run. So, we think of this more like less like a commercial real estate portfolio where you're shooting for a 0% loss rate, and more like a consumer credit card portfolio where you might have a 2 or 3% loss rate and you're pricing for it.
Yeah, to me, that would be much more logical. The credit union can set its own lending criteria. They can decide, well, we're not going to lend into this sector, for instance. True?
Correct. Yeah. So there's kind of two components in simple terms for to the implementation. One is, we roll out the credit model, which doesn't change by credit union. It produces a probability of default. That becomes a rule that the credit union sets for, what's the threshold for auto approval. And then beyond that, there's a series of configurable business rules that the credit union sets, and we work through it with them. So you mentioned excluded industries as one, but it could be minimum time in business. It could be minimum revenue thresholds. There's about 25 of them that we look at that the credit union can consider.
And the credit union can also determine how many months of cash flow they need.
That's right. Yeah. So we our minimum is 6, so we won't underwrite on less than 6. But if they want to say we won't underwrite on less than 12 under any circumstance, they can say that.
I know in the U.S., the vast majority of credit unions wouldn't want to lend a dime to a cannabis business. But there's also about 100 or so that really want to lend money to cannabis businesses.
Yeah. Yeah, it's funny. We have a couple clients that do, but like you say, most don't. I was just at the CUBG conference this week in San Diego, got back last night, and one of the credit unions I was talking to there was asking me if I knew of any credit unions that would refer out that business to them. So they're quite keen on it.
Oh, yeah, there's a handful and these are smart credit unions. In some cases, they've been asked to get into the business by state government, which wants to get a little bit of the cash out of that business and into banks and credit unions.
Yeah. It's an interesting one, and there's some margin in it, I think. So, yeah.
So what's your next step in this business? What's the next evolution?
It's sort of continuing to do two things. Obviously, grow the customer base and the size of our data set, because that's one of our real assets, is just the fact that we've been doing this for now, 10 years, including our time as a lender, and we've accumulated a pretty big set of performance data. So we want to continue to do that, but also add functionality. So, things like we're working on an embedded lending project where you can put loan applications inside of different software applications where small businesses live on the internet. We're working on a second look program where we can actually evaluate a borrower based on 2 credit policies. So if they don't pass the credit union policy, there's an instantaneous application of it to the second look partner, and you'll be able to, on the spot, be able to tell the small business, hey, we can't help you, but our partner can. So we're really trying to get to the point where credit unions can serve their members in a really broadly in terms of, if they don't have a solution, they can say yes somehow.
Has friction with Canada in the U.S. White House had any impact on your business?
Yeah, very interesting question. I would say no, it hasn't to date, and for, I guess, a couple of reasons. There's been no tariffs on digital services so far in either direction. There was a little bit of a talk about it at one point, but I think that the U.S. is such a net exporter of digital services that probably won't happen. So that hasn't come to fruition. So it hasn't affected us in terms of the ability to work with credit unions. you could debate whether there's an economic impact happening, which we're, maybe seeing in terms of credit quality and application volume. Canada, we've seen a bit of a drop in application volume of late, and that may be related to economic circumstances, that may be related to tariffs. But, different people will have different points of view on that.
Might also, at least in the U.S., be related to what increasingly looks like an inflationary spiral.
Yeah, and we haven't seen the change as acute in the U.S. yet as Canada, but actually just this week I got an email from about a client that was noticing some changes in sort of the foundations of the economy. So we'll see. It's an interesting time as always. Well, and one of the things that we like about the way we underwrite in our platform is, to the extent changes are happening in real time, we see the changes to cash flow in real time. And this was true in the pandemic as well, where.
Well, that's the beauty of doing cash flow. One thing that happens in a small business, and I've run a small business for most of my life, is when the economy gets rocky, suddenly those bills that pay like clockwork on 30 days or 60 days or sometimes 90 days. It's so you see like an almost instantaneous impact on your cash flow if you're a small business and the economy begins to go into a recession or inflation is out of control, et cetera. It's so quick. So you would be able to see a lot of that data too.
Yeah, that's the nice thing about the methodology is when the economy is dynamic and in flux, you're going to catch things sooner than you would with tax returns or financial statements or a bureau score, like you say.
Now, how does AI figure into what you do? And it's in the company website address. So where's AI playing here?
Yeah, there's a couple of spots where we use it. And it's all related to the cash flow data. The first is just to make sense of the cash flow data. So you get a bank statement and you have to turn that into something that's legible, basically. So we have a categorization engine that transforms a bank statement into a synthetic cash flow statement. So there's some basic AI in there to do that. And then the main application of it is in our credit model itself. So the way I always explain this is we're transitioning from sort of a rules-based underwriting process, which is what you see with scorecards that use, say, financial statement ratios, to a behavioral-based predictive model. So we're looking at the behaviors around cash flow, figuring out how they interact with each other and then producing them a score out of a multivariate model. And so that's a very different approach than saying, if you think about the move from that rules-based approach, like a common rule would be a 1.25 debt service coverage ratio. Now that's been established over the course of time based on intuition and rough experience, but it's not scientific. Why isn't it 1.2 or 1.35 or 1.31? Like, it's just sort of arbitrary. Whereas with a predictive model, you can actually figure out what exactly that should be. The second thing is, rules or model variables don't operate in isolation. So there may be, cases where a 1.1 debt service coverage ratio is totally fine if you have an 800 credit score, or if you keep $1 million of cash in your account at all times. So there's an interplay that rules don't capture that behavioral models can capture. And then the last one that I always talk about is, what if you just have the wrong rule? And this one's really interesting. So debt service coverage is fascinating because that's the way that commercial lending has always been done. But with small businesses, they're cash out businesses in our experience. And we have lots of data to show this. So they don't run profitably. They deliberately, commingle personal expenses and conflate CapEx and dividends. And so they're driving to roughly a break-even point on a net operating cash flow perspective. And so when you apply a traditional commercial lending metric like debt service coverage, it's going to lead you to say no most of the time. But that's not necessarily the right answer. And so what the AI can do, and it can look for different variables, different behaviors that are predictive of risk beyond the traditional metrics.
And what you're saying makes sense to me as a partner in a business. And when you say that, I remember my partner and I would pay ourselves more or less depending upon the cash flow.
Exactly.
And we wanted to have a certain amount of money kicking around the company accounts. But in the good months, we take more out for ourselves. It's in a bad month, we take a lot less out. So, so if you're using that metric, it's not always going to make a lot of sense with a business that runs like that. And I think a lot of them do run that way. So.
Yeah. And that's why we really, one of the sort of our mantras is to think about small business as a segment. It's not commercial lending and it's not consumer lending. It's in the middle, and it really is different. It's big enough to be its own segment, and it needs a different mindset. It needs different tech. It needs different credit criteria. It needs a different owner inside the credit union, all that kind of stuff.
And it's underserved. It's a great opportunity.
Yeah, hugely underserved. And the data shows it all everywhere you look.
And there's all kinds of small businesses. There are farms, for instance, fewer and fewer, to be honest, that are small businesses. But there's still, in parts of the United States, there are a lot of small farms that probably have trouble getting loans. It's, there's wonderful opportunities there.
Yeah, there's no question that it's a massively underserved opportunity. One that could, serving it better could have huge impact. There was a study out of McKinsey recently that talked about how small businesses are about half as productive as larger businesses, and part of the challenge there has been they're undercapitalized, so they can't get as productive. And the punchline in the whole thing was the impact of making those businesses more productive with more capital could be something like to the tune of 5 to 10% of GDP in the U.S. So,
wow,
just an enormous issue for the economy that and if we solve it, would have huge impact, but also could be quite profitable. Again, years ago you couldn't do this profitably, but now you can. It actually can be one of your better lines of business.
Yeah, and for the doubters, we saw exactly this during the pandemic. Government loans. It was purely automated, streamlined. Yeah, there was no risk because they were all government backed, but nonetheless, they could make loans really quickly.
And aside from the workflow, that with the technology now and the models, the AI models, you can manage the credit risk quite effectively too, without spending hours and days on a file.
Before we go, think hard about how you can help support this podcast so we can do more interviews with more thoughtful leaders in the credit union world. What we're trying to figure out here in these podcasts is what's next for credit unions. What can they do to really, really, really make a difference in the financial scene? Can't all be mega banks, can it? It's my hope it won't all be mega banks. It'll always be a place for credit unions. That's what we're discussing here. So figure out how you can help. Get in touch with me. This is rjmcgarvey@gmail.com. Robert McGarvey, again, that's rjmcgarvey@gmail.com. Get in touch. We'll figure out a way that you can help. We need your support. We want your support. We thank you for your support. The CU 2.0 podcast.